Okay, good afternoon to you all. I want to spend some time with you about the instructions of the second assignment or the task or the presentation or everything. The instructions are here in Optima. If you go to the Start Here folder, you would see a file called Course Description Management Accounting. And if you open it, it's quite a long document. But let's go to the B part, which is the corporate risk management group assignment and presentation / because you can do it in the group form, but then of course you have to present it. So I wrote it here that corporate risk management group assignment, if group assignment, then present it / individual assignment, no presentation. And like your previous assignment that you have done very well, this also takes 25% of the entire course credits. Now, what you need to do, choose a multinational company, public listed company, and non-financial, non-utility. As the same rule apply that banks or the utilities, they are very heavily governed by the regulators. So even though these banks or the utility companies are falling in the purview of the private sector, the state intervention is enormous in these kind of corporations. So let's call them out of question. So no financial institution and no utility organization. And I think you followed this rule very well in the first assignment. I don't think anybody took any hedge fund or any bank in the last analysis. So to make it simple, I would say that keep the same company, because you first see the nature. I think I said a few times before that the nature of the first task was to diagnose the risks, and the second assignment's nature is to give some remedy, some treatment. Okay, so if you keep the same company, then probably we can know more about. You can have the better outcomes, more relevant information. I think you can provide. Analyze 1 year's annual report, preferably. I think now when I made this draft, then 2019 annual reports were not available for most of the companies. But I would say that if you take 2019, that's great. But see what, I don't care about the year unless it's 1983 or something like that. So if you take 2019, 2018, 17, it's fine with me. But don't go too much in the past. Don't take 2010 or something. So anything around 16, 17, 18, fine. If you get 2019, it's fine. If you don't get it, don't do it. Then the best candidate is 2018. Analyze a risk management report. I would show you with one example that there is a risk management report, and this actually, you know what, the annual report of the company is like constitution of a country. So every other report will be somewhere in the annual report, okay? You need to find what? You need to find the risk factor section. So if you're good at typing, and if you use some keywords in the annual report, because it's easy to use the keywords rather than scrolling 300 plus pages, if you are able to type in risk as one keyword, risk management could be another word, okay? Financial risk could be another word. And then you are able to use 3 more words. And that is the forward. Remember, we have done forwards. The futures, I would say just type in singular so that you don't miss out anything, because some companies call it future, not the futures. So forward, future, and option. Don't do swaps, because as I said before, that swap is a bit more than just the average technical stuff. So I don't want to harass you with because this is a little bit more. If you have no interest at all in finance, then I think swap can be a bit complicated for you. But if you have interest in finance, then of course, we will discuss in financial management course. And if you do track, then we will study there as well. So there's plenty of opportunities. So I'm not including I'm not including swaps in this assignment, okay? I'm giving a statement. I'm not including swaps in the entire management accounting syllabus. So you should be able to, if you use the keywords, if you type in the PDF annual report, then I think it's pretty good that you will be not going too far. So the keywords like risk management, the forward, the future, the forward future option, and one more word if you can find, hedge or hedging. Hedge or hedging. So that can also, because some companies use hedge or hedging is a very informal expression. But some companies, some accountants, they don't mind using informal expression and they can call it hedge. If you want me to spell it, how it looks like, wait a sec. Stop share, new share, yeah. Share. Okay, so I repeat, I hope you can see it here. Text here, okay. Can I type in? Okay, so if I'm a student and I want to look for the main important words, keywords rather, to do my assignment, I would use these kind of things. Currency, word, or risk. I can even try one word, risk management. I will also try this word hedge or hedging. Forward, I would definitely try. Forward, I will even try the future, and option. So this will take me straight away to those words. And if those words are relevant, important for you, then of course, you can utilize them. So these are the words which I think will be. Is there any other thing which you can try to get any information about? Oh yeah, risk factors. Risk factor is very important because first of all, you need to see where are the risk factors. Factor or factors. Usually they're plural, so that's how it goes. So that's something which you should be be ready. So you call them as keywords. Keywords, and these words will help you definitely to extract the information straight away from the PDF. Now I stop sharing it, and I share this thingy. Yeah. Now, before I discuss with you this point, risk management policy, I would first see the risk factors from the annual report of the company. There's always a section of risk factors, which I would show you with some example company that there are some risk factor section. The companies admit that, hey, these are the major risk factors that we can have the exposure to. But I want you to be smarter than the company executives. Remember, you have done the first assignment. And in the first assignment, when you were presenting, many of you, you had a section called SWOT, strength, weaknesses, opportunities, and threats. In that section, you can also find out the weaknesses of the company, which the company doesn't admit, or the company executive didn't see it, but you guys were in a position to pinpoint those weaknesses and the threats. Okay, so that you can highlight as well. So the message I want to give you is that you first see the risk factors which company admits that it is exposed to. But the buck doesn't stop there only. It goes beyond. And what goes beyond? Add the factors which you have spotlighted during your presentations. Okay, some of them could be common, but if you are adding an additional weakness and threat factor to the company, that is a big contribution of yours to this kind of applied research. Okay, and then when you have made a list of these risk factors, try to correlate that which of the risk factor, now you have identified those risk factors. How the third step would be, after you have made a list of factors, 5, 6 factors, they come from risk, they come from the weakness part of your presentation, they come from the threat part of your presentation, and moreover, it also comes from the risk factor section of the company, which is in the annual report, definitely. After you make a list of these factors, you try to see in reality means which the company admits in the annual report, plus make some kind of educated guess or some kind of imagination or some kind of forecasting that which of this risk would be even more painful to the company if there is a change in the exchange rate. The reason is that because all the examples that we shall do will be in the context of the Forex, in the foreign exchange rate. So I want you to correlate this information with the Forex. So for example, when the company says that there can be a shortage of raw material, okay, and then you can highlight that, okay, if there can be a shortage of raw material, it would be even more painful if there's not only shortage of raw material, but even if there is a imported raw material become expensive, that would be even a big problem. The company says that a big threat to the company is the technology becoming outdated. And then you can add to the currency risk that if this technology is imported, if the company is importing this technology, then this threat can be even more severe. So try to link these points with the currency fluctuation, the Forex fluctuation or the exchange rate fluctuation. And then you try to find the treatment, that what is the remedy, what is the treatment. And the treatment will be coming from these. Well, there are different ways of treatment actually, but in this course, we shall only focus on the currency futures, the currency forwards, and options. How the company can make use of, or is it making use already? It could be possible that the company is already using futures, forwards, and options. Okay, and if the company is not using it, then you jump in the picture and give the company a suggestion that, hey, you admit that you have the risks. Why don't you use these 3 instruments so that you can do better hedging? Okay, so here you can act like a consultant to the company. And if the company is using them already, then you can also talk a little bit about the merits and demerits, about that which instrument is better. And these things you will know, that which instrument is better in which context. This you will know as we study them. We have studied one already. I guess it was 2 weeks ago. That was the currency forward. Today, I shall discuss the currency futures. And if all goes well, I shall also discuss with you half of options. Okay, that's it. So if I make a list of what I have done, what I have discussed today, make a list of risk factors. Risk factors will come from the annual report. There should be a section of risk factors. Make a list of that and do some study that how the company admit those risks can dent the company's future. Secondly, you also see, if the company is same, you also see which risk factor you shortlisted in your previous assignment. Okay, then the list will become bigger, and then try to relate that how this risk can be even more if there is a exchange rate fluctuation. And once you do that stage, then come the last stage, that which instruments, which tools, techniques of risk management the company should resort to, which instruments it should use. And we shall discuss 3 instruments of risk management / hedging. And those are futures, forwards, and options. No swaps for this course, okay? And moreover, if the company is not using them, then you can jump in the discussion and give them an advice that, hey, you should use it because they're so important, they're so useful. Why don't you guys use it? And if they're using it already, then you can have a discussion that which they should use or which one is better. So then you can compare, you can make a comparison between. It's like when a patient is, when somebody is sick and the 3 alternative treatments, and somebody said, no, this medicine is good. No, this medicine is very good, but it has very strong side effects also. That the second treatment is better, even though it's slow, but it has no side effects. And third person said, no, I think it should go for the surgery straight away. So these 3 tools, the futures, forwards, and the options are 3 alternative medicines to treat the risk exposure of the company, okay? Remember, this is a philosophical statement. No company can ever have 0 risk. So no instrument can ever remove the risk. But what you can do at the most is to minimize the risk or manage it. Risk is eternal. Risk is there forever. It will remain forever. So these couple of things you should keep in mind when you are preparing your assignments, or if you also are making presentation. Okay. One more thing I want to discuss with you, that the second assignment, I don't want you to put numbers too much. This is again a very big statement I'm giving. I don't want to see so much of data this time. Data thing is done. Now you act like a consultant. The data analysis made us decide which are the strengths and which are the problem areas of the company. Enough. Now we shall discuss the merits and demerits of these risk management tools, which can provide some remedy to the company's risk exposure. And here, your arguments are more important than the data. So if in the presentations, or if in the assignment you have table after table after table just took from the company's annual report, it's not going to serve any purpose. Okay, you can make even a smaller report, I don't care, but it has to be well argued, very well deliberated, and the strength of the argument should be more important. So you act like a consultant. Consultant, if you ever visited, he never talk about data, that this is the ratio, this is the ratio. No, they just provide you the main idea that, hey, I think we have analyzed the data. I will not share the data analysis with you. We have done, my expert team has done the data analysis, and now we know where the shoe pinches, where the problem areas are. And now we are providing you the solutions to it. That's it. That's the main job. So not too much of number crunching this time. The number crunching assignment was number 1. It's over, done. The merits, demerits of each hedging instrument. Lecture slides are, basically you will give you some ideas. Of course, you can also refer to the other resources if you want. I can help you. References, please give if you can. And number 6 is a kind of a rough layout, how the report should look like. But honestly, I don't want to stop your creativity. If you have the better layout, do it. But just be careful that you are able to, So once again, the rule of the presentations are there'll be 2 minutes, 10 minutes presentation and 2 to 3 minutes about the discussion. If you're individual, it's fine. The return box is there, everything is there. So these are the instructions, or some quick catch up with the assignment 2. Okay, so I have a quick recall of what currency forwards are. The currency forwards are basically an instrument of hedging, and the company buys this contract and this contract you buy from usually it's a bank, it's a big multinational bank which deals with the forwards. Not every bank at the high street would be dealing with the currency forwards at least. You are a Finnish company, and this Finnish company is going to buy something from Australia, and you will be making the payment in Australian dollars. And if you keep your position naked, in the sense that you don't take any risk insurance, because you will be making a payment after 6 months, then you are always under a threat that if Australian dollar become more expensive against euro, in other words, if Australian dollar appreciates against euro, it can kill the company's cash flows. And then you go to the bank and you explain your position, and the bank manager say after negotiation, when you deal, he or she offers you a forward rate that, hey, this is the forward rate. Let's lock in today. Let's keep it fixed today. That after 6 months, for the next 6 months, whatever is the exchange rate in the market, we don't care about it. You can buy your total import payment of Australian dollar from me at this specified rate of exchange of 1 Australian dollar equal to certain number of euros. And then if it suits you, you take it. Now you don't have to worry about it. You don't have to look at the Australian dollars exchange rate on an hourly basis, because you know that the market will not affect you anymore. So you get some kind of immunity of the exchange rate fluctuations. And in this example, which I gave you, you are a Finnish company, you are importing something from Australia, and you make the payment in Australian dollars, and you're scared of Australian dollars getting appreciated against euro, the home currency. Now, the second example, you are a Finnish company, and you have sold something, some output, to some Canadian company, and the Canadian company would pay you in Canadian dollars, but they would make payment after 2 years. Okay, they will make this payment after 2 years. Now, if you keep your position uninsured or uncovered or naked, then the risk is that if Canadian dollar depreciates, become very cheap, lose value against euro, you will get less money after 2 years or whenever you get this money. So now you buy a forward contract to sell Canadian dollars already today. So you make a deal with the bank manager that, hey, we are afraid of Canadian dollar becoming depreciated after 2 years. Then this manager would give you some offer rate that, hey, this is the rate I can offer you. You can sell your the equivalent amount of Canadian dollars at this exchange rate, and then we don't care about what the market rate is. So basically, as a customer, as a buyer, the company would always buy a forward contract, either to buy a foreign exchange or to sell a foreign exchange. In the first example, you buy the company, the Finnish company, buy the forward contract to buy Australian dollars in the future. But in the second contract, the Finnish company buy a forward contract still, but this time to sell Canadian dollars, which it will receive after 2 years. So by doing so, of course, you pay the fee, you pay the transaction cost, all these things, but it's like an insurance. Okay, like I think I use the metaphor of car insurance, that even though you are the best driver in the world and you are very safe, but there's always a chance that the car can just, you can ram into somebody, and somebody can be scratching it, or there could be some accident, and there is even without your fault, and that repercussions can be huge. It can be very expensive if you have to. So therefore, you buy car insurance. Now you can repent that, hey, there's no accident for the last 5 years. Why do I pay insurance premium? But just imagine that if you don't have the insurance and you have some unfortunate situation, it will cost you a lot. Okay. So that is the whole idea. There is a risk of being uncovered, unhedged, unprotected, or what we call as a usual term in finance, naked position. The company can never keep its position naked. It must hedge. It must protect itself from any fluctuation. The fluctuation never come from the exchange rate only. It can come from inflation. It can come from the rate of interest. It can come from the price rise, anything. But I have to give you some example after all, and I can't give you millions of examples. So I took the situation, I took the example of the exchange rate fluctuation. That's why I'm using this word currency as a prefix in front of forwards, futures, and all these instruments. So the currency is basically some kind of background. The Forex market is some kind of background which I'm using to explain these instruments. I have two messages in the chat. Let me read it first, and I'm resuming it now. So we go to the futures. One feature I don't remember now whether I discussed with you or not, but one feature is very important to study about the forwards before we start learning futures. About the forwards, I think the best way is that I draw a picture. So let me share my screen with you with another thing. Share screen, and I share the whiteboard with you. Okay. I draw something. Oh, what's happening? Now, if you see this graph, and if I want to make a text, and just imagine that you bought the forward contract. You are a Finnish company. I think, Anu, now you can learn it again, this whole thing. You are a Finnish company, and you buy something. You make a deal with the Australian company on 9th April 2020 that you will buy something from Australia, but the payment will come. You will make a payment on, let's say, 9th April 2021. If you see here, you make a deal with the bank on 9th of April 2020, and you buy the forward contract. And if you see that the only time, and then you take this instrument and you keep in your locker, you don't open it, that's it. You don't sell it to anybody else. It's not that you buy something from the bank and then you sell it to somebody else. No, this is yours. You keep it because you lock in. I explained the word, what is lock in last time. So you keep it with you. So if I draw another picture, there's a blank. There's a blank here. Nothing happens between these two lines. Nothing happens. Between 9th of April 2020 to 9th of April 2021, when you actually buy Australian dollars at the forward rate, the pre-decided forward rate, and you make the payment to the bank, during this time, nothing happens. It's all like a Grand Canyon, like a crater. Nothing happens in between. It's a big valley. Nothing happens. But about the future, everything is same as the forward is. But the thing is that here, something happens every day. Can you see? That makes it different. So something is happening every day on. So you become richer, you become poorer on every day. That's a difference. That's something which makes a different from, and I'll explain it to you why it happens. Sometimes the price goes up, sometimes the price goes down. Uh, every price increase or decrease make you richer or poorer. This is a message I want to deliver to you, that when it's forward, then nothing happens between today and the deadline. Nothing happens in between. It's a blank. It's a silence. But when it comes to futures, and I'll explain it now. I just want to give you some kind of a, what is the word in the movies we use as a teaser? Yeah. So I'm using this teaser that about the forwards, there is nothing happening between two lines. The start date, 9th April 2020, the finish date, 9th April 2021, nothing happens. But when it comes to the futures, things happen on daily basis. Okay, but I haven't explained it yet, how and why. Okay. Marina, you asked me about that. Can we actually cancel the contract, the forward contract? And my simple answer is no, because we lock in. Nothing can cancel it. I'll give you an example. 9th of April 2020 today, you decide to buy some metals from an Australian mining company, and you will be paying them, let's say, 25 million Australian dollars in 1 year time. It means that you can go to the bank and you buy the forward, and you say the bank manager that, Mr. Manager, can I buy the forwards? And you make a deal and everything is done. The contract is signed, so all the formalities are done. 10th of April 2020 means 1 day after signing the contract. Something happens and you cancel the contract. You, the Finnish company, cancel the contract with the Australian company. No more import from Australia. No more import from Australia. No 30 million payment, 30 million Australian dollars to Australia from the Finnish company, no. But then you realize that, hey, yesterday we also bought a forward contract. You contact the bank again and you say that, you know what, thank you very much. We signed the contract with you yesterday, but today there has been some developments and we have canceled the contract with this Australian company. So we don't need 30 million Australian dollars on 9th of April 2021. So can you cancel the contract? The bank manager would say, this is not possible. You cancel the contract with the Australian company. It's an issue between two companies, the Finnish company and the Australian company. Bank is not responsible for your business dealings. Even if you have canceled the contract. On 9th of April 2021, now this wording, quote unquote, the bank manager is telling this Finnish company that, okay, fine, I'm sorry to know about your situation, but we can't help it. On 9th of April 2021, you, the Finnish company, you still have to buy 30 million Australian dollars from us at this rate. So on 9th of April 2021, you make us a payment in euros and you give the Australian, we give you Australian dollars. Do whatever with them you want. Marina, have I answered you?
Yes, yes. And the second question.
Go ahead. Why I'm not able to? I can hear you now, yeah.
Okay. Since I cannot make this deal with two different banks because, well, the idea of the second question was like, what if the bank, I don't know, just, I don't know, goes bankrupt or just for some reason the bank cannot comply with the agreement, then I cannot make the same deal with two banks because I should pay for it. It's a lock-in, as you explain it. So this is as far as I can go like to ensure this price, this currency price, right? I mean, there's no other way. For example, if for some reason the bank closes and I lose this deal with the bank, and then I will have to pay increased prices. Let's just say if it's 5 times higher the currency rate, I will have to pay because there's no other way to work around. If the bank,
yeah, your question is very valid, Marina, but that's a very extreme situation.
Yeah.
We believe in the law of normalcy, that the business as usual. Of course, there could be possibility that the banks can fail, but then the central bank of the country will come in the picture, or some other banks will take the responsibility. I know there have been the banking failure, but in the event of the banking failure, then normally the central bank of the country and the Ministry of Finance, they come in the picture, and then they are making some kind of syndicate of the other banks who would share the responsibility of this sick or the dead or bank. Like for example, sometime it can happen that we do as a group work something together, and maybe 2 days before one of our partner becomes sick, very sick rather, and he or she can't work, then we all jump in and we try to do his or her part. So if a bank becomes sick in the system, then the other banks will come, and who will ask these banks to come for the rescue? It will be by the order of by the central bank of the country and the Ministry of Finance. So yeah.
Right. Thank you.
In a very extreme case, when the entire financial market would collapse, then it's a different situation. When the central banks or the ministries of the country find it impossible to honor their obligations, then it's a different situation. But in the business as usual situations, banks do fail as well, I would say. It's quite, it's a bit like a kind of statement. But sometimes the banks are in the crisis. Okay. I normally ask my students a question, but in a different context, that banks are very crucial for the country, for the economy, and the governments and the government of the country normally never allows a situation when a bank fails, because banks deal with the financial hub they are, and finance is the life and the blood of every organization. You can have fantastic plans, nothing will mature if you don't have money. Okay, and you can have the great creativity, great idea, piece of technology, but if it doesn't appeal to the customer, here comes the marketing. But if the customer doesn't pay you, if you can't finance your innovation, then that thing will never mature. Okay, the banks are never allowed to fail in the normal circumstances. If a company, non-financial company, making some furniture or automobiles, if it fails, there's a big headline, there's a big row, big news. But then the tremor, the shocks are not as strong as if it is a bank which fails. So the bank failure is a very catastrophic situation. Okay, and if it fails, or if it is, as I said before, that the banks are usually not allowed to fail. Now this is a bit strange. How can I say that? It's like saying that, hey, this person is not allowed to die, or this person is not allowed to be sick, because bank is so important for the economy. And if a bank is giving some signs of sickness, some symptoms of sickness, then the government and the banking system of the country jumps in the picture immediately, regardless of the fact the bank is in the government sector or in the private sector. The private sector banks are also governed very heavily by the government. That's one reason I disallowed you to take a bank as a company of your choice or assignment 1 or assignment 2, because they are different animals altogether. Yeah, so the banks, if there is a problem, then the other banks will come for the rescue. I hope I answered your question.
Yes.
Okay, so now we go to the slides. So it's almost 1 hour. So let's study futures now. The futures, if you recall the definition I said, the futures are also involving 4 specificities. The specificities are, I give you an example. A Finnish company is going to buy some metals from Australian mining company, and the contract takes place on 9th of April 2020. And the contract, the deadline when you make the payment and you buy the metals from Australia is 9th April 2021. And the rate of exchange which you fix with the bank is $1 Australian is equal to 0.83 euros. In other words, the rate you fix with the bank, the forward rate, is equal to $1 Australian is equal to 83 European cents. Now, for specificity, specific currency, which is Australian dollar, specific amount, 30 million Australian dollars, specific rate of exchange, $1 Australian is equal to euro 0.83, specific time, 1 year. And these are the same specificities which were in case of forwards. The same 4 specificities are available or must be there in the future also. And the question is that if they both are same, then what's the difference? The difference is that, well, first of all, they look very similar. They're like, I call them as the first cousins, the forwards and the futures. The difference is that the forwards you buy from a bank. It's like shopping. You go to the shopping in city center. You buy something of your choice. So you shop it. The future is not shopping thing. The futures, you don't buy it from a specific shop. The futures you buy from like a stock exchange, like a big market. When you buy this contract, the forward contract, it's OTC because it's you, the party, and the bank manager negotiating. This kind of negotiations have no room, no place for the futures. The futures you buy from a market, like a stock exchange, where there are many buyers, many sellers, like that. So one thing we learn from the future is that it's not OTC, it's not over the counter, it cannot be tailor-made. You buy it from the big market. Okay, you buy it from the big market. And the second feature which differs, which makes futures different from the forward, is that the line which I drew on the graph, and that was the forwards, you cannot walk out of the contract at all. As Marina asked me that, can you leave? And my answer was no, big no. The futures, you can. You can buy the future contract tomorrow, today, and you sell it, you go out of it tomorrow. That's the beauty of the futures. And here I want to give you the same example, which I gave you, but now I explain it with the help of the futures contract. This time, and please mark my example, it's very important. You can write it down somewhere or just please remember it. This time, you are a Finnish company and you have some surplus amount in euros, and you want to buy And you think that in the future, Australian dollars would become expensive. And you think that, hey, can we do some speculation? We have some money here and there is no other investment which we can do. Can we play in the market? Play means, can I take advantage of market fluctuations? And you think that in the future, you have some economists working, some finance guys working in your company, and they make some kind of projection that, hey, we have a strong reason to believe that Australian dollar will become expensive against euro in 1 year's time. Okay, good for you. And you, this time, don't go to the bank. And you are going this time to the future stock exchange. I won't say stock exchange, but it's like a future exchange, the big market. And you contact a broker, not a bank manager, but a broker who's like a sales buy, like the car dealer who has like buying car and selling cars quite often. So you meet some broker who is a specialist in Australian dollars, and you say that, Mr. Broker or Miss Broker, I want to buy Australian dollars, and I want to buy an equivalent of 30 million Australian dollars. What rate do you offer? And the broker says, okay, all right, let's sit down. I can offer you 1 Australian dollar for 83 European cents. Remember, it's the same price which I quoted before. The deadline of the contract is 1 year, 9th of April, 2020. 30 million at the price, 1 Australian dollar is equal to 83 European cents, 1 year, okay? Do you take it? And you say, yes, I take it. Let's sign the contract. And you sign the future contract with this broker. And the date today is 9th of April, 2020, okay? The contract says that you can buy 1 Australian dollar for 83 cents anytime from now until 9th of April, 2021. And remember, in case of forward, nothing happens between today and deadline. But in the future, when you sign the contract, you can buy, in this example, the Australian dollar anytime from today till the expiry date, which is 9th of April, 2021. And guess what happens tomorrow? Tomorrow, 1 Australian dollar is equal to 2 euros. It becomes so expensive over one night. Okay? And you say, hey, this is a jackpot. You know why? Because yesterday on 9th of April, now I'm talking about 10th of April, the next day, when 1 Australian dollar become equal to 2 euros. But on 9th of April, you signed a contract with the broker that you will be buying 30 million Australian dollar at a price. 1 Australian dollar is equal to 0.83 euro, 83 European cents. And the next day, the price jumps to 1 Australian dollar to 2 euros. You go to the broker, you buy 30 million Australian dollar at the price 83 European cents. You get these Australian dollars, and then you sell it in the market for 1 Australian dollar is equal to 2 euros. In other words, you have the right to buy an Australian dollar for 83 cents. But when you see the market price, the very next day, look, your contract is for 1 year. Your contract is for 1 year, but just next day, 10th of April, 2020, the Australian dollar become very expensive. For 2 euros, you have the right to buy 1 Australian dollar for 83 cents, European cents, and then you can sell immediately that Australian dollar for 2 euros, basically. There we go. And the contract is over. So in one day, you bought the contract, and the next day you sold the contract. You don't have to wait. Now 9th of April 2021 is redundant, useless thing. It's over. So the beauty is that in case of forward, something happens today and something would happen at the deadline. And you can't walk out of the contract. But in the futures, if the price, in the future, we don't have the point of times, we have the flow of time. So something is happening. That's why I drew this kind of picture on the whiteboard. So the next day, the price suits you, you just walk out, simple. So that's the beauty of the futures, that it's market tradable contract. There is no market in case of forward. You buy the forward contract from the bank, it will stay with you, nothing change. But in the futures, you buy the contract, now you sell it next moment, because there's a market for it. There's a future market for it, what we call as a future exchange, basically. So this contract is marketable. Which contract? The future contract. The forward is not marketable because there's no market, because it's between you and the bank. You asked me a very important point, that why would somebody get its leg stuck in the mud? For example, the forward contract is so rigid and the future contract is so flexible. The forward contract gives you the flow of time. Something happened today and something would happen at the deadline. Nothing happens in between. But the future, you buy a time window, 1 year in between. When things suit you, you board off the bus. That's it. Why would you do it? The question is the psychology. The question is the mindset. You know what? In finance, the behavior, the psychology play a big role. What is your psychology? What is your behavioral characteristic when you are actually going to buy something, some metals from Australia, and then you are afraid of Australian dollar becoming expensive or appreciated? Because in this case, you are a genuine importer. You need Australian metal in your factory. Somebody would be processing them in Uvascula somewhere and then maybe selling it to this Canadian company afterwards. So you are genuinely a manufacturer, trader, business person. But remember, when I gave you the second example of future, I said you are a finance person of this Finnish company and you have some surplus money and you have a strong reason to believe that Australian dollar would become expensive in the future. I didn't give you the example of the Finnish company, that you need some metals from Australia. Because in the second example, you have some surplus money and you want to play with it. You want to invest. You're looking for some alternative investment. What should I do with my millions of euros? What should I do with them? There's no other investment. So can I be the beneficiary of the market fluctuations? You want to play against the market, basically, in case of the futures. So in the forwards, you are defensive. You are scared of Australian dollar becoming expensive. So you use forward as a defense mechanism. Whereas in case of futures, you are more upfront. You are more aggressive. You are prepared to take the risk. And the same company would do it, by the way. So in the one department, they say that, hey, we need some metals from Australia. Okay, we genuinely need some shipment of metals. Then you like to go with the forwards because it's certain that you need metals. Whereas in the other group of finance experts in your company, they say that, hey, we have some surplus money, or we can at least borrow from the bank at almost 0% rate of interest. And our business is not so lucrative. Can we play in the market? Can we be aggressive and be the beneficiary of the market fluctuations? So there's a difference of mindset in the futures. In the futures, you are aggressive. You are like you want to take the bull by horns. You want to play against the market. You're prepared for the risks. So you are not defensive. You're aggressive. Buying the future contract shows your aggressiveness, that you want to, you are prepared. You are intellectually and financially prepared to take the challenge. Whereas in case of forward, you are a genuine, you need some inputs from Australia. If you don't have those metals, the factory will shut down. So here, you are genuinely, so if I can say that in case of futures, you have more speculative component, whereas in case of forward, you have a genuine transaction, the manufacturing, trading kind of mindset. So that there is a difference of mindset. I hope I explained it.
That explains it.
You can do the hybrid transaction that, hey, we are genuinely buying something from Australia. Okay, we need some raw material from Australia. But if Australian dollar become expensive, I can walk out as well. So if you have this kind of mindset, then you can buy futures and it will serve you both purpose. If you don't sell your futures contract till the end, then there's no difference between forward and future. The only thing is that, if I can say so, 99.999% future contracts, they are never kept till the date of maturity. They are transacted or they're cancelled beforehand. Because the people who buy, the investors who buy futures, they're more speculative. But if you want to have this kind of best of two worlds, and you want to buy the futures, then I would say the futures are more expensive to buy. The transaction cost of futures are far more than the forwards. Forwards are rigid, but at the same time, their transaction cost is cheaper. So that's the one reason that if you are genuinely buying something from Australia, okay, you buy a forward contract to buy Australian dollars in the future. If you are a genuinely supplier to some Canadian company and you are afraid of Canadian dollars becoming cheaper, that would kill your revenue in your income statement, then you should buy the forward contract to sell Canadian dollars. So in the forward market. But if you're not doing this thing, you have some surplus money and you think that this money is losing out in the bank deposit because this saving is in the bank. The bank is offering you 0% rate of interest, rather negative interest rate. And you say, hey, we have so many millions of euros in the bank. They are rusting basically. Can we play in the market? Can we take some risk? And we have a strong reason to believe that Australian dollars would be expensive. So when you have this kind of speculative mindset, then you are, when you want to be aggressive, not the defense. Forward is more like a defense thing. The futures are more aggressive. Then you go for the future contract. When you have more risk-taking ability or willingness, then you go for the futures. One technical thing about the future is that about the forwards, you can make everything is customized. So there is no, you can deal with the bank manager, and as long as those things are mutually acceptable, it's fine. But in case of futures, the futures deadlines are normally third Wednesday of March, June, September, and December. So you can only get 4 deadlines in the future market. And these are usually in the month of March, June, September. So after every 3 months. And one more feature about the future is that we use this phrase, mark to market. Mark to market. Mark to market means you are daily mapped or marked by the market. And when you have this kind of mapping by the market on daily basis, you either get richer or poorer. Example I've given already. You have a future contract to buy $1 Australian, at 0.83 euro on 9th of April. On 10th of April, the price of 1 Australian dollar is 2 euros. You are marked to market overnight. How much? You bought something at 0.83, the price have gone up to 2. The difference is 2 euros minus 83 cents, 1 euro and 17 cent. You are richer by. You are richer by. So the mark to market, you have become richer by 1.17 euros for each Australian dollar the next day. So you are marked by the market positively because you have the right to buy for Australian dollar for 83 cents, but the price is now 2 euros. And when you multiply this difference of 1.17 euros over 30 million Australian dollars, so you can make how much money you have made in euros. That's a huge amount of money you made. Okay, but then there's a risk also. Okay, so I think I'll explain this mark-to-market example with an Excel example. So I'm going to share with you one spreadsheet. Well, not sharing with you, but I'm going to make it in front of you so that we can work together. So let me share it with you. You share Excel. Okay, I hope you can see the spreadsheet, yeah? And I try to zoom in so that you can see those numbers a bit big. And what I'm gonna write is here, because I don't want to get this keyboard, so I'm muting my mic for some time. Okay, so I think now we can discuss about it. There is a Finnish company where the finance manager says that they have some 2 million euros to invest. And because the banks or the other alternative projects are not so lucrative, not so good, can we be the beneficiary of the market movement? So they choose to invest in the, and this company doesn't need anything from Australia. They don't need any metals or any fruits or any kiwis or any Shiraz or anything from Australia. They just want to pump this money in the market because they're very optimistic that the Australian dollar would appreciate against euro. And I'm using the word mark to market. Mark to market. Let's say the contract size, the total contract size is, contract amount is 2 million, let's say, which is, I mentioned about 2 million. And these are 2 million, 1, 2, 3, 4, 5, 6. And these are, by the way, yeah, so maybe you want to buy 2 million. The contract size is 2 million Australian dollars. All right. Mark to market. The first day is your contract price. The second day, the price goes up. The price goes up. So what happens is that, are you richer or poorer in one day? May I ask you? You bought the future contract at 83 cents for 1 Australian dollar on 10th of April. So the first is blank. On 10th of April, the price of Australian dollar, and these are, by the way, spot rates. These are the spot price. Spot price. And the market, spot means the market price. The spot price on 10th of April 2020 is 1 Australian dollar is equal to 97 cents. I repeat my question. Are you richer or poorer in one day?
Richer.
Richer by how much?
0.06.
Excellent. So if I subtract this from this, you are richer by how much? 14 cents, yeah?
Okay.
Yes.
And when you multiply, this is for 1 Australian dollar, yeah? This is for, you earned 14. And by the way, this I should also write that these are euros so that we know which currency is which. So you earn 14 cents in one day for 1 Australian dollar, yeah? And how many Australian dollars you have the right to buy? 2 million. So I can call it total gain or loss. And this would be again in euros because euro is your home currency. All gains, losses are in euros. Because you gained 14 cents for 1 Australian dollar in one day, and your contract size is, so basically you have become richer in one day by, if I multiply 14 with 2 million, but I put the dollar sign in between so that it remains fixed. In one day, your account is plus by how much? 28? 280,000. You become richer by 280,000 because I just multiplied these two values. The gain per Australian dollar multiplied by the amount of Australian dollars you have the right to purchase. And remember, the deadline is 9th of October 2020. And the start date is, of course, no, this is the start. Okay. So the start date is 9th of April now. Okay. If this was a forward contract, this thing will never happen. Nothing will happen in between. You remain fixed at your position. But in the futures, because it's a market trading contract, So you can become, market can make you richer or poorer on daily basis. Like for example, you bought something on 9th of April, on 10th of April, the price went in your favor and you are richer by 280,000 euros. But you know what? But even though the deadline is 9th of October 2020, but guess what? On 11th of April, things don't go very well for you. The price goes down. And when the price goes down, guess what? Price goes now from 97 to 86 and you lose 11 cents. You lose 11 cents. And when you lose 11 cents, you lose something like this. So the day one, you are richer by 280,000. The day two, you are poorer by 220,000. And I'm making a very unfortunate picture. It goes even worse. And when it goes worse, it goes even worse here. You lose another. Oh my gosh, you're losing so much. And then you lose even more on third day. And you lose even more here. Let's say this is, I'm adding one more column here. Let's say on 13th of April, you make a decision that, you know what, the company's CEO is very, very angry and he's sacking his CFO. He said, hey, you gave me a damn bad advice and I followed you. And look what the company is doing. We are losing out. So I'm sacking you from here. But when the company want to come out of this contract, it decides that, hey, enough is enough. Enough is enough. Let's sell all the Australian dollars on the 13th of April, get rid of it and see what we have done, what we have. So in these 4 days trading altogether, the company has licked the dust, basically. The company has lost a lot of money. So that's why it's not a guarantee that you will always gain from these contracts. You can win or lose. Market is making you richer and poorer, poorer, poorer every day. And when the market is making you richer or poorer, this is called the phenomena called marked to market. So this is called marked to market thing, that the market is marking you on daily basis. So this is when you, where let's say you, because you buy, you have the, so you sell the contract now. You sell the contract, you say enough is enough. We made a bad choice. And the contract is over. You pay overall 340,000 to your broker and just walk out of the market. It was not your day. This is how the contract, the trading is done in the future market. But imagine, the luck could go in your favor. Maybe on the day one, you lose something. But on the next day, you gain, and then it becomes even more. And it becomes even more. So, and you say that, hey, you know what? I think it's good time to walk out of the contract because the dollar, Australian dollar, will not appreciate forever. And we have made a lot of money. So before, it's like when you start winning the bets and you say that, hey, we can't win forever. Let's walk out before we start losing out. And in this case, you ultimately gain 460,000 euros and you walk with the pride out of the financial market. And you say, you know what? Who will make you richer by 460,000 in 3 days' time, basically? But as I said, it's a risky contract. So it can make you poorer, it can make you richer, depending upon how the market treats you. That's why I use the word marked to market. I should format it to 2 places, otherwise. Yeah. So this I can share with you. So future, the currency future calculation. Remember, one thing is that you, in this case, you buy future. You buy future contract. You buy a future contract to buy a foreign currency. So when you buy something and the price goes up, it's good for you. Like for example, if I buy a house today, an apartment for 60,000 euros today, and tomorrow the price goes up to 65,000, I'm a gainer, because if I have waited for one day, I would have paid 5,000 more. So basically, when you buy something, any further subsequent, consequent price increase makes you richer. But if you are a seller, then it's not the same thing. For example, you bought a house for 60,000 euros today, but tomorrow the price goes to 70,000. Well, you could have earned 10,000 euros more. You lose 10,000 basically. Okay, so the price increase is not always a panacea that you will be gaining something. It's not a guarantee. Depends who you are. You always buy the contract from the broker, but to buy or to buy contract to sell. In this case, sorry, say again. So because you are thinking that the Australian dollar would appreciate, so you buy the contract from the broker. But what does it say in the contract? That you will be buying. You will be buying. You agree that you'll be buying 2 million euros, 2 million Australian dollars from the broker in the future. So this is how. So the price increase is making you richer. Okay. Now, is this example okay with you? Do you understand it?
Yes.
Okay. So this 460,000 is basically your total cash flows. If these cash flows are positive, you win overall. If it is negative, you lose overall. It depends who you are. So you are more aggressive in the future market, whereas in the forward market you are more defensive. You're more defensive because you genuinely needed something from Australia and you are going to buy something from Australia. So that makes it a little bit, yeah. But I want to give you one more example, actually. I want to give you example this time to buy future contract to sell a foreign currency. Sell a foreign currency. Okay. So I want to give you one more example. I want to copy it and the new sheet hope it pastes. Oh yeah, good. So if I zoom in, after this example, I'll give you a break. And, yeah. But I don't want to leave you now because it's very important that we understand this phenomena otherwise. So to buy a future contract, to buy, this time I say to sell. Foreign currency. A Finnish company's finance managers say that the firm has 2 million euros, which are like a surplus and a possible investment to sell. Possible investment to sell. Now this time I use the word sell. And I use CAD, the Canadian dollars. Future now. since there is a high possibility that the Canadian dollar will depreciate against euro in next 6 months. Again, let's bring the CFO back, who we sacked in the previous example. The CFO is saying to the company CEO that, hey, Mr. CEO or Miss CEO, sorry if I'm a bit gender biased. We have 2 million euros to invest. These 2 millions are in the bank, and we don't have any, these are just like lying, non-performing asset. There's nothing much we can do with it. And I have a strong reason to believe that in the next 6 months, the Canadian dollar will depreciate. In other words, the Canadian dollar's price is high now. The price is high. Let's sell them in the future market right now. And in the hope that when the price will become cheaper in the 6 months' time, we buy it back. We buy it back. And you agree. You say, hey, yes, let's sell them. Remember in the last example, in case of forward, there's a reason why I took Canadian dollars. Because in case of forwards, you sell something to a Canadian company, you send the ship full of stuff to Canada, and this Canadian company will give you Canadian dollars in 6 months' time, and you are afraid of Canadian dollars depreciating. So you buy the forward contract so that you get the minimum price from the bank. So I'm again keeping the same example, but this time I'm not saying that you are buying or selling something from Canada, but this time you are speculating. This time you behave like a speculator, okay? So the mindset is different, even though the movement is same, but the mindset is very different in this case. Here you are more aggressive. Okay, what happens now? Euro, so I change first of all the currency units. It's a 1 Canadian dollars, no Australian dollars. Only Canadian, euro, 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 and this is also CAD, Canadian dollars. You make a contract today to sell 1 Canadian dollar at 83 cents, and the contract value is 2 million Canadian dollars, and the date of expiry is 9th of October 2020. Okay, and you'll be marked to market. Today, you sold something for 83 cents. And the thing which you sold for 83 cents on 9th of April, on 10th of April, its price is 73 cents. May I ask you, are you richer or poorer? Something you sell for 83 cents on 9th of April. On 10th of April, the same thing, the price is 73 cents. Are you richer or poorer?
Obviously poorer.
Richer.
Richer. Because you sold for 83 cents. Had you waited for one more day, the same thing you would have sold for 73 cents. So you would have lost 10 cents in that case. But here, so that was the reason that I asked you. So in this case, you are richer. So I have to slightly change the formula. 83 minus this. So you are richer by 73. You're richer by 10 cents. The next day, the price goes to 86 cents. It's like saying that you sell something for 73 cents on 10th of April, whose price is on 11th of April is 86 cents. Had you waited for one day, you could have become richer by 13 cents, but because you lost it, because you sold it, so you are losing 13 cents. And had you waited for another day, it would have been another 12 cents addition, so you lose it. So basically, when you have this selling contract any price increase is making you poorer. Like if I say so, you sold the house for 60 million, you sold the house for 60,000 euros today. Tomorrow, the same house, 70,000. You basically have lost 10,000. Day after, the same house is 75,000. You have lost another 5,000. So when you are selling something, any subsequent price increase will make you poorer. Okay, so you need to know the mindset of this thing. And how much is your total profit or loss? Well, you need to write the formula. The formula is you win for $1 Canadian, and the amount is this. So I fix it so that it doesn't change. So overall you win, but unfortunately the other days you lose. So altogether you have a loss in the contract. So there's a reason I took this example, because when you buy future contract to buy Australian dollar, any price increase, any decrease makes you poorer, any increase makes you richer. But when you're selling something, like in this case, the Canadian dollar, any decrease makes you richer and any increase makes you poorer. So it's very important. Yeah. If I'm a same CFO, if I have a hunch that this currency price will go up in the future and I want to speculate, then I would buy it. I would buy the currency future. And if I know that this Y currency's price will fall in the future, and I also want to get the benefit of this fluctuation, in that case, I would sell that currency in the future market. Okay, so you can try to speculate against price rise and also the price fall, but it depends whether you become successful or not. In this case, when the price is increasing, you're losing out, basically. And maybe after a few days, you decide that, hey, you know what, enough is enough, let's leave it. And you just walk out. Look, the contract date, expiry date is 9th of October, 2020. But do you want to wait it if the thing continues like this? Or if you show some patience, maybe things get better in the future. But it's easy to say in the hindsight. But then on 13th of April, you decided, you know what, I think we should leave it now. Right? So basically, as I said before, that 99.999% cases for the futures, you will never go till the deadline. And if you go till the deadline, then there's no difference between forwards and futures. And if you don't want to maintain any difference between the forwards and the futures, then why don't you buy forwards, which are cheaper in terms of transaction cost? And the reason you buy forwards and the futures also reflect your mindset. If you are having very speculative mindset, then I would never advise you to go for the forwards. Go for the futures, because they are more flexible. You don't have to wait till the end of the period. But if you are genuinely buying something, selling something, then I think it's not a wise idea to go for the future market. Then stick to the forward market, because it's very simple and shut case. Like you make a contract with the bank manager, there's no market involved. Everything is very simple. But in case of futures, the market involvement is on daily basis, and that's why we use the phrase, you are marked, not market. You are marked to market every day. The market is marking you every day. So you are marked to market. Basically, sell the contract. So because you sold the contract, in this case, you buy back the contract. So you do the opposite. So because you sold, remember you sold $1 Canadian. And if you sell on this price, you gain, you sell on this, and because now you can't take your loss anymore. So the opposite of selling is buy it, so that the contract is over. I give you, I'm recording it now, carrying on. I want to show you which part of the annual report can help you to do your second assignment. And as I said before that, the annual report of the company is like a constitution of it. So everything would be in the annual report, but you must know how to look at it. So what I do here, I will be sharing the screen first with you. New share screen. Annual report, I think so. So I hope you can see some. You can see this British Petroleum's annual report. Can you? Okay.
Yes.
Very good. Now, if I scroll it down and go to the contents page, if I zoom in a wee bit, and you'll see that there's a section called, but I must forewarn you that not all the companies' annual reports have these type of content, so you have to search for it. I just randomly picked up BP, and I found that they have something called how we manage risk and what are the risk factors there. So it means that I know that if I spend some time on page 68 to 70 around, I would get some information about the risk factors. So I get inspired and I go straight away to page 68 and see what they have there. And when I go to page 68, which is, yeah, I start. So it shows their risk management policy. So I think in the assignment, even though I didn't say, but if you can say a little bit about the existing risk management policy, that what are the main characteristics of the risk management policy, the company in question, it won't be a bad idea. Okay, so there is some information about the risk management. They even say that who are the people who do this risk management job, basically. So they mentioned that there is a day-to-day risk, there is a business and strategic risk, and there is some governance risk. But as we go down to, so there are more risk, the climate-related risk. There are some financial liquidity risk. There is a security risk, for example. So they have risk factors here mentioned, the price and the markets. And I told you that you try to relate it with the foreign exchange, the forex fluctuation, the exchange rate fluctuations. So price is a big risk. So if, for example, BP is importing some technology, and they are going to make a payment in the foreign exchange, then the appreciation of the currency in question can make it very difficult for BP. So they must do some hedging. And if BP is going to sell something, and you know that the oil price is very volatile, and if the price goes down, then it can kill the cash flows of BP. So in that case, they have to sell. Maybe they have to buy a forward contract to sell the foreign exchange already in the market. And there could be some collaboration if they have some collaborations in Russia, and they are buying plant equipment in Russia. And if ruble become more expensive, more appreciated against pound, it can be a problem. Okay, but if they're selling in Russia, and if ruble become depreciated, it can again be a problem. So keep in mind that these risk factors should be considered. And geopolitical, BP has many of its operations in West Asia. And you know that in the West Asia, the situation is very volatile. And because of those political problems, it can be expensive. I mean, it could be possible that they have invested a lot of money in Syria or other parts of the world. And because of these geopolitical crisis, those projects are basically abandoned. And they have liquidity risk, immediate paying capacity, and the liquidity, we did the liquidity ratios also. There can be competition. The oil market is very competitive, and And on top of that, there is a alternative to oil already in the market. So that makes oil market shrunk. And because the companies, the big giants like BP are still around, so that makes the whole industrial atmosphere very competitive. Okay? And security is always a problem. Safety is a problem. The product quality is also a problem. So these kind of things are posing risk to the treasury and the trading activities. And there is a, that is also a risk that the financial loss can make the company's performance very bad. And then I go down, and even though this section is a very dedicated section about risk management, but I will not settle for less. And when I go down and I use my keywords, which I mentioned, options, forwards, and the futures, and then I see that for this company, BP, there's a note 29, note 29 I saw here. Yeah. So this note is basically even more. So this note 29 is all about not just risk factors, but the financial risk factors. And which are those financial risk factors? They are discussed here. So this is a fantastic piece of information. They have the market risk. The commodity price can go up and down. The foreign currency exchange risk is big risk. The interest rate risk can be more. If BP is a British company, it borrow from an American bank, then it faces two risks. First, the rate of interest in the US can go up. And secondly, it is making payment in American dollars. So it also have a problem if American dollar appreciates against British pound. So, and the credit risk. So all these risks you can correlate with. And then what type of instruments they should use. Okay. And you know that we will be using, so the note 29, for example, is a very big note about financial risk and their risk management. So something similar will be also available in your case company as well, I'm very sure. Otherwise, you look for the keywords which I gave to you, and you will definitely get something. You have to show some patience, because if you use the word future can be used in many contexts. Hey, the future is very bright. It has nothing to do with finance, about the derivatives. But show some patience, and or look at the contents page already, and that can give you some idea that where this risk management information can be. But otherwise, show some patience, use the keywords rightly, and hope for the best. And in case the company does not actually use any of these, they don't say anything about in their report about the financial risk and their management through forwards, futures, and options, then you can, based on your analysis of your first assignment, where you make a list of weaknesses and threats, then you can make some kind of educated guess that, hey, if this risk is actual, and if this risk also involves the cross-border payments, then the company is also exposed to the currency risk fluctuation, and how they can manage. Well, they can manage with these three instruments which I mentioned. So you can also make it like a what if analysis. But I think this what if analysis would be more relevant for the small companies. If you have chosen the big company, like for example, BP is one of the mega companies in the world, you will have more information. And that was the whole idea in the beginning, that you choose a company which is pretty well-known, renowned, because the big companies, they normally give you more information. Okay? But if your company has less information or almost no information, then you can do it based on what if analysis, or what we call as a scenario analysis. That, hey, just imagine that if these risks are true, and they also involved forex payments, and how the company would handle this situation. So, Yeah.